Hi, I'm Tom Elliott, Director of Beulah Capital. Welcome to another share market update for the month of February 2013. Well, the share market's been in a very bullish phase over the past couple of months. Reasons for this are pretty simple. Obviously, the American market's been going up, and well, American shares have been rising because investors were heartened by the fact that Barack Obama was able to deliver on his promise to conquer the so-called US fiscal cliff. Now, what that really means, of course, is that he's agreed with Congress that the overall amount of money that can be borrowed by the American government will now be lifted. That, interestingly, has occurred around 60 times since the end of World War II. So it seems there's no end to this pattern of borrowing more than the country can really afford and then spending it on things that, again, it probably can't afford. But the market doesn't want this to end anytime soon. And that's the main reason the share market has been going up. I guess the good news from the perspective of the real economy in America is that it is showing definite signs of revival. Now, the US has got quite a few things going for it, leaving aside the issue of government spending for the moment. It's pulling back from Afghanistan, which, although that could actually decrease US GDP in the short term, obviously is a good thing for the overall welfare of the country. Secondly, interest rates in America remain resolutely low, and indeed the US Federal Reserve is committed to keeping them this way for at least a couple more years. And thirdly, the US is in the middle of an energy revolution. Shale oil and gas, a bit like our coal seam gas here, not quite the same but similar, is making domestic gas in America very, very cheap. Now, America at the moment is not allowed to export this gas, which is good for our local LNG producers, but it can use it for its own industry, and American industry is responding by both increasing production and hiring more workers. So the US economy is going better. There is a few positive signs emerging from France and Germany, but the point is the market has already decided that Europe's a basket case. Any bits of good news that emerge will be good for our share market. And the Australian share market for the last 18 months has been stuck in a trading range of around 3,950 to 4,450. It is now well and truly broken out of that range and is now around 4,900 points. Interest rates were of course kept on hold during February. The Reserve Bank left them at 3%. I still reckon there's probably another 50 basis points of cuts, and indeed if you look at fixed rate home loans, they're pricing in actually a bit more than that, around 70 to 75 basis points of further cuts. At some stage pretty soon though, I do think we'll probably reach the bottom of the interest rate easing cycle. But at the moment, debt, relatively speaking, in Australia is cheap. It's cheap by our own standards, historically. Of course, Australian interest rates do remain much higher than the rest of the world, and that is the reason that the $A does not want to go down. Even the Reserve Bank suggesting rates might fall further, our dollar is still just under 104 US cents. One of the things that low interest rates have done for our market is really improve the allure of yield stocks. I mean, Telstra is at a 4-year high, trading over $4.60 a share. Just 18 months ago, it was down at I think $2.56 was the low. So Telstra shares have had a massive recovery. Of course, the banks have been very, very strong. Even the National Australia Bank, which has been a laggard because of its problems in the United Kingdom, its share price has appreciated. CommBank has hit record highs recently of all time. That is higher than it was pre the global financial crisis. And also infrastructure stocks, Sydney Airports Corporation, Transurban for example, they're doing very well. And property stocks like Investor Office Fund, which we hold. Again, quality companies or property trusts that can pay a solid rate of dividend in an environment of low interest rates will still be sought out by the market. Yields have gone down as the market's gone up, but the yields available in the share market, particularly when you include franking credits, are still a lot better than what you'll get on term deposits at the moment. But I really think all eyes have got to be on the banks, because bank share prices have gone up quite dramatically. I'm not so convinced that bank profitability justifies the share price increase. Yes, the banks pay good dividends. Will they be able to fund those dividends in the future? Only time will tell, but at the moment anecdotal evidence suggests that credit growth at the banks is virtually non-existent. Now, they are still making good margins on loans, but again, if interest rates bottom out soon, it's going to be harder for banks to do that. In an environment where credit isn't growing, it's hard to see how profits can grow very much. So that's what I'll be looking for in the upcoming reporting season. With our income portfolio, which again, as the name would suggest, we focus heavily on income stocks. Banks, of course, have been a major driver, along with Telstra, of that portfolio's considerable appreciation, and we look at least for those dividends to be maintained, if not increased. Actually, interestingly, Transurban, which we hold in both the income and takeover portfolios, announced even though its earnings had fallen slightly, it's increasing its dividends. So Transurban knows how to spot a trend, knows what's attracting investors. Investors ignored the earnings cut and focus on the dividend increase there at Transurban. With regard to other takeover stocks, I think GrainCorp is still worth looking at. It's got a bid on the table. Things have gone rather quiet. The stock is trading only a little bit above the bid from Archer Daniels Midland. I think GrainCorp and Archer Daniels Midland will soon resume their talks, and I do think that Archer Daniels Midland, especially now the overall stock market has gone up during the period of this bid, will pay north of $13 for GrainCorp. And also Echo Group, that's been a stock that we hold as a takeover stock, hasn't performed very well, but I do think once James Packer's Crown gets permission to increase its stake beyond 10%, they will do so hopefully on market. And finally, I guess one has to look at other investment related stocks. In our main portfolio, the Beulah model portfolio, we've done very well holding IOOF, which is obviously a fund manager, and of course the ASX itself. Both of those stocks benefit enormously from a rising share market. All right, that's it for now. Look forward to your company same time again next month.